This is my own trading robots backtest, and this number right here, minus 53.7%, is the one most sellers crop out of the screenshot. I build and sell these things for a living, so you should be suspicious of me. Good, that is exactly the right instinct, and this video is built for it. Because today, I am putting my 3 trading robots next to the most boring investment on Earth, an S&P 500 index fund, and I am leaving in every number that makes my side look worse.
If you have ever bought an expert advisor because you saw a green curve going up, you bought half the information. The other half decides whether your account survives. 3 things in the next 13 minutes. 1, the honest case for just buying the index fund and never talking to someone like me. 2, 3 things that pitch never mentions. 3, my own numbers. Drawdown first, including the one that should scare you.
Let me argue against myself first, and I want you to notice that I mean it. The S&P 500 has returned roughly 10% a year since 1957. Not in a simulation, in the real world, through 11 recessions, a dot-com collapse, a banking crisis, a pandemic, and an inflation shock. It costs almost nothing. A broad index fund charges a fraction of a percent, and you can own 500 companies from your phone in about 4 minutes. It asks nothing of you. No VPS, no broker requirements, no license key, no leverage, no settings you can get wrong at 2 in the morning. And here is the part my own industry hates saying out loud. An index fund does not require you to trust a stranger's code. You are not betting on my honesty or my competence. You are betting on 500 companies showing up to work. So if you take nothing else from this video, take this. For most people, most of the time, the index fund key is the right answer. I would tell my own family that. Now let me show you the part that never makes it into that advice. Compound interest is a promise about the destination. It says nothing about how long the trip takes. Rule of 72. Divide 72 by your annual return and you get the years needed to double your money. At 10%, that is about 7.2 years. Adjust for inflation, because what you can actually buy is what matters. And at a real 7%, you are waiting more than a decade to double once. For a 28-year-old with 40 years ahead, that is genuinely fine. For a 45-year-old with $30,000 and a plan that needs more than 1 doubling, the word fine is doing an enormous amount of work. Second thing, ask a robot seller for their maximum drawdown and half of them change the subject. Ask an index investor the same question and you usually get a blank look because nobody ever printed it on the brochure. Here it is. The S&P 500 fell 49% in the dot-com crash, 57% in 2008, 34% in 5 weeks in 2020. Those are not backtests. That is the safe option's actual behavior. And the fall is not even the expensive part. The recovery is. 7 years to get back to even after the dot-com peak, 4 years after 2008. If you bought in 2000, your money did not grow for most of a decade. It just came home. Time in the market beats timing the market is true. It also quietly assumes you have the time. Third thing, and this is the one that matters to me as a builder. A passive index fund has no mechanism for reducing risk when conditions get worse. None. It cannot see a regime change. It cannot reduce exposure. It takes 100% of every fall by design, because taking 100% of every rise is the entire point. Set and forget is beautiful. Right until the moment forgetting is the expensive part. 2 smaller leaks sit under that. Fees compound in the wrong direction, about $450 per 10,000 over 20 years at a 0.15% expense ratio. And the order of your returns matters as much as their average.
So the honest question is not whether index funds are good. They are. The question is narrower and less comfortable. Is a decade of waiting the only price you are willing to pay? And is there anything active that actually deserves your trust? That second half is where my industry keeps failing you, because almost everyone selling automation crops the chart. So here is mine, with the crop removed.
Everything from here is a backtest. 2021 to 2026, Monte Carlo method, full reports published. A backtest is a hypothesis about the past, not a live account, and I will come back to why that matters. Cenith first, and I lead with its drawdown on purpose. 25.79% maximum drawdown across 5,857 trades on GBPUSD. Its exhaustion filter waits for a move to run out of breath before it commits. On that pair, at 5-minute speed, impatience is exactly what gets punished. The backtest return was around 900%, $10,000 becoming roughly $101,000 at a profit factor of 1.63. The return came second. That was the design brief. Protect the capital first. Golden trades gold, which does not trend so much as detonate. One FOMC sentence can move the metal $100 before you finish reading it. Independent basket trailing lets every position manage its own exit, so the strategy survives the chaos instead of betting against it. The backtest, around 2,200% across 1,627 trades, and the price of that number was a 44.76% maximum drawdown. And Omnicore, the headline machine, and the one I am most careful about. On Euro USD, the most liquid pair there is, its auto lot scaling grows position size as the account grows. Under aggressive parameters, the 5-year backtest compounds roughly 12,000%. And this number travels with it permanently, 53.70% maximum drawdown. At its worst point, more than half the peak equity was gone, and the system had to be allowed to keep working anyway. If you cannot picture yourself sitting through that, you just learned something far more useful than the 12,000%. One more thing, and I need to be precise here. The 3 expert advisors themselves are rule-based. There is no AI inside them. Anyone telling you their EA thinks is selling you a word. What sits above them is the AI trading agent. The robots read the chart. The agent reads what the chart cannot show. Volatility against a 252-day window, trend structure, and correlation across all 3 pairs at once. It outputs one risk budget for the whole account. And there is an equity curve pause. When the system's own results degrade, it stands itself down before you have to notice. A strategy that can fire itself is rarer in this business than any return figure.
Now, put them side by side. Look at that honestly, and you will notice something inconvenient for me. Omnicore's backtested drawdown sits between the 2008 crash and the dot-com crash. My aggressive machine is proposing a ride about as rough as the 2 worst decades the stock market has had this century. That is not a footnote. That is the product. Here is the full comparison. The row I would read twice is the one about trusting a stranger. An index fund needs no faith in any individual. A trading robot means betting that the person who wrote it is honest and competent. That cost is real. It belongs in the table, and no amount of good backtesting removes it. Everything else on that list is arithmetic. That row is character, and character is only ever judged by what someone shows you when the numbers are unflattering.
Numbers do not tell you what you will live through. So let me. The index path is quiet. Year 1, you barely notice anything. Year 4, you check the balance. It is up maybe 40%. And it is good news that does not change your life. Then a bad year takes 1/5 of it back. If you had bought in 2000, you would have spent 7 years watching your money walk back to where it started. Nothing dramatic happens in those 7 years. It is a low-grade nothing. And most people can carry it. A few cannot. And the few who cannot usually sell at the worst possible moment. So, buy the index fund and close this video. If you have 10 or more years, you want to touch nothing, and sleeping well is worth more than any number here. That is not humility. It is the right answer for most of you, and I would rather lose the sale than win it from someone who panics in month 3. Consider the robots if you understand what a 25 to 54% drawdown does to a real balance, and you have $10,000 on a standard account. Or you would rather test it on a cent account from $100, where the same machines run at 1/100th of the scale. And honestly, most people should do both. Keep the index fund. It is the floor of your financial life. The question was never robot or ETF. It is what the next 10,000 should be doing. And before you trust any of my numbers, run this on me. Ask for the maximum drawdown. Check it covers the same window as the return. Ask whether it is backtest or live. Look for third-party tracking. Ask what stops the system when it stops working. If a seller fails that list, walk away. That includes me. My live tracking is on MyFXBook, and the full reports for all 3 machines are on the site, with the drawdown printed next to every return. Link is in the description. If you want to ask me something directly, the Telegram channel and my email are there too, and I answer both myself. Last thing, and it matters. Everything you saw is a backtest, not live results.
Forex trading carries a substantial risk of loss. Past performance does not guarantee future results. This is not financial advice. If this made you check a number you were not going to check, it did its job.